Hello, students. How are you doing? Okay, so this is a question that I uploaded yesterday in the group, and I expect that most of the students have already done this question. If you haven't, you can just download the question and have a look at it and try to solve it. Again, this is a question for task 2. All right, so let's have a look at it. So you're working as a financial consultant for a company that has recently encountered issues with its account receivable department. During your review, you identify the following weaknesses. It means that some of the weaknesses in the question is already given. Let's have a look at the requirement first. So for each of the four weaknesses identified, identify and explain the cause of the weakness. That's for 8 marks. And it means for each weakness, you got 2 marks. And explain the potential consequence for the business. Okay, again, you have another 8 marks for this. All right. So what we have to do, we have to identify the weakness, and we have to explain the cause of the weakness, and then we are going to figure out the consequences. Let's first talk about um, the cause of the weaknesses. Okay. So you are the financial consultant for a company that has recently encountered issues with its account receivable department. During your review, you identify the following weaknesses. Outdated procedure manual. So the procedures manual was last updated 5 years ago and does not account for current digital payment methods such as BACS, which is Bankers Automated Clearing Services. Employees have been assuming that the old procedures apply to these new methods without proper guidance. All right. So what can we do? We have to first identify and explain the weakness and the cause of the weakness. So obviously the cause of the weakness is that the procedure manual has not been updated in 5 years, which would be leading employees using outdated guidelines. So that's not going to account for the modern digital payment methods like BACS. Okay, so this is the cause of the weakness. Most of the information was already given in the question, so you would just rephrase it. Then we are going to talk about the potential consequence. So the potential consequence of using the outdated procedure manual is like quite evident, and that is, if they're using the outdated manual, it means that they're going to make errors in processing payments, right? It would because they are not using the updated guidelines. So obviously, they're going to make errors in that. And then they're going to have increased processing time, and the business were definitely going to have some potential financial losses due to these inefficiencies or mistakes in handling transactions that involve newer payment methods. Okay, so yeah, that's quite evident. Okay, let's have a look at the second one. So automatic credit limit assignment. So what they're doing is they are assigning the credit limits automatically without reviewing it manually. Okay, so new customers are automatically given a credit limit of 5,000, right? That's big, that's not small. Okay. Without performing any credit checks. So this policy has been in place due to the belief that it simplifies the account setup process. All right, so we know that what is the weakness and what is the cause of this weakness. So the policy of automatically assigning 5,000 credit limit to new customers without conducting any credit checks um, is being used just to simplify the account setup process. So again, in identification, you are just rephrasing the answer. So that is basically the cause of the weakness. Okay. What could be the potential consequence for business? So this is going to be resulting in granting credit to the customers who are not financially stable to support such a credit limit. Okay, so if you are giving credit to the customers which are not credit worthy, so you are increasing your risk of bad debts, because there is a possibility that the customer might not be able to pay back that amount. So, that would lead to bad debts for the company. Okay. And then, the business is going to have financial losses uh, in incurred because of um, this system. Okay, this is exactly happened. That is the exactly reason why we had 2008 financial crisis across the world, because U.S. banking system, they were assigning the credit limits to the customers who would otherwise not be able to be given that type of credit limit. But they were doing it primarily for the mortgages, and the underlying concept behind that was that um, even if the customer is not able to pay the amount, we would confiscate, the bank would confiscate the property, uh, that mortgage house, and then, recover the amount. But, there was so many mortgage houses in the market at that time that because of the increased supply of those houses, the prices fell down and banks were never able to recover their amount. And that led to 2008 crisis. Okay, all right. So the the fourth thing is pressure to override credit limits. So sales staff frequently pressure the accounts receivable supervisor to allow customers to exceed their credit limits to meet sales target. Okay, so the sales staff is trying to meet their sales target. So what they're doing is, even if a customer is not credit worthy, sales staff would be pressurizing the accounts department to allow uh, credit limit to those customers. Okay, so the supervisor often compiles to avoid conflict, but no formal record of these overrides is kept. Okay, so the supervisor um, is uh, com- so supervisor is complies to avoid conflict, but no formal record of the overrides is kept. Okay. Obviously, the reason is evident, and that is, um, the sales staff pressurizing the accounts receivable supervisor to exceed the credit limits for customers to meet sales target. So combined with the lack of formal documentation of these overrides, so that's going to be um, the the biggest reason for this weakness. What could be the consequence for the business? So the lack of formal records and frequent overriding of credit limits could lead to financial instability, uh, increasing bad debts, and um, that would be resulting in challenges in tracking credit exposure and ultimately risking the company's financial health. Okay, all right. Then we have inconsistent debt collection practices. So the company's manual suggests sending formal reminder letters when debts are overdue by 2 weeks and escalating to legal action if unpaid after 1 month. However, the accounts receivable team prefers informal phone calls, leading to inconsistent follow-ups. So uh, this is the problem with the recovery of debts. So you are not the staff is not following the proper channel, the proper formal channel. Instead, they are following the informal channels. So that's definitely going to have um, delays in recovery of those those debts. So the cause is that the account receivable team preference for informal calls over formal procedures outlined in the manual leads to inconsistent follow-up on the overdue payments. And the consequence is going to be that this inconsistency can result in delayed or missed debt collections. So this will lead to cash flow issues and increase potential for uncollectible debts. Okay, all right. Now let's go to part B. So a recent fraud incident involved an employee who stole customer credit card details while processing payments over the phone. Discuss the financial and non-financial implications of this fraud for the business. So again, a recent fraud incident involved an employee who stole customer credit cards. So the employee stole a customer's credit card while he was processing the payments over the phone. So that's definitely going to have um, financial and non-financial implications. Let's talk about that. So um, you are definitely going to have the financial implications like, let me make some white space. Okay. Okay, so you guys can think for a moment and see that what could be the financial implications for this type of fraud incident. So, okay, you can pause the video and think about it. So the direct financial impact includes legal liabilities. Yeah. Because there is a possibility that when customer get to know about this incident, they would file a legal complaint against the company. So, and if the company is found negligent in this process, they would have to pay some legal penalties. Yeah. Um, Probably there could be some compensation cost. So there is a possibility the company would be paying compensation amount to the customer, um, even if they go for out of court settlement, and even if court orders to pay some penalty to the customer, some compensation to the customer. So it might result in company paying some compensation to the customer. So that can be another financial implication. Um, Okay. And then, the company would definitely need to do um, some security measures. If this type of incident comes on surface, so there are some security measures that need to be taken. So company might be doing that, and that could be um, an expense. Okay. And probably, they would be conducting investigations. So that would be another expense. And if, as a result of the investigations, there are more incidents like that, so company might be paying more legal or more compensation to the customers. Okay, so these are the financial implications. What could be the non-financial implications? You can pause the video and think about the non-financial implications. So the non-financial implication, the first is definitely the reputational damage. If this comes out, customer would not be comfortable with doing business with your company, right? So, because that's going to be a huge reputational damage. Okay. Um, Employees' morale, because the good staff, they might not be feeling comfortable working with the company because they would not be they would not be confident about the internal control systems of the company. So yeah. And then you could also have the regulatory scrutiny. So the relevant regulation bodies, they could open an investigation against you, and um, you know that's going to be, and they would be having um, more um, more focus, or what can I say? The more they would be more stricter with the company, right? So these are some of the non-financial implications. Let's have a look at the other question. All right, now we are at part C. So you have been asked to review the company's risk assessment process. So based on the following scenarios, assign an appropriate risk score from 1, 5, and 10, low, medium, and high, and justify your answer. Okay. So the company allows its sales team, number one, we're talking about. So the company allows its sales team to use a company credit card for travel expenses. This card is shared among all team members and is kept in a drawer in the office. All right, that's cool. So, we come across these type of questions quite often in the scenario. Okay. So, um, how would you score this risk? Um, I mean, what is the likelihood of the fraud happening? So the likelihood is high, and the impact is going to be high as well. Yeah. So likelihood is high, impact is high as well. So the risk score, in my opinion, should be 10. It's high. Whenever, how would you justify your answer? So whenever a card is shared among team members with minimal control over it, so it increases the risk of misuse or fraud significantly. So the lack of individual accountability, there is no individual accountability in this case. No one knows that who is using the card, so there is no individual accountability. So it is further alleviating the risk. Okay. Let's have a look at the second scenario. So the account receivable department only reconciles the bank statement once a month, despite handling large volumes of transactions daily. Okay, so um, they are handling large volumes of daily transactions and reconciling only after a month. This is very risky because bank reconciliation statement is a type of control which reconciles the cash book with the bank account to see whether they are being matched or not. So if they are handling high volume of daily transactions, it means they should be doing it more frequently. So even if they detect a fraud at the end of the month, they could not do anything about it. So delayed detection of discrepancies or fraud could lead to significant financial losses. So I would rate this risk high as well, at 10. And the third scenario, is the account receivable team uses an outdated software system that frequently crashes, leading to delays in processing customer payments. Okay, all right. So the system is outdated. While the outdated software causes delays and inefficiencies, it is wasting the time of the staff. The risk is moderate because these issues are more about potential inefficiency rather than direct financial loss. I mean, you are about to make a payment to um, about a payment to a supplier, but you are, you got the payment you got a payment from a customer, but the software is not updating it, but you got the payment, right? So whenever the software would be in good condition, um, it would process the payment, right? So you're not having any financial loss. So this type of risk, I'd say that this is moderate. This is medium risk. So you'd call it 5. You score it 5. Okay. Okay, so I would give you a written answer to um, this question as well. So you can have a look at it as well. Thank you. Thank you very much. Bye-bye.